What's going on, guys? Welcome back to the channel. Today we have an interesting topic. It's going to be on how to invest your trading profits. So I always get asked the question, hey Ray, I've made some money in the markets, but now I don't know what to do with it. Should I just leave it in, my trading account? Should I put it in the bank? How can I invest this money to potentially make more off of the work I just put in? Today, we'll be covering those topics. So make sure you're tuned in for the entire video. Also, make sure you comment, like, share, and subscribe. So let's go ahead and jump into this topic. It's interesting because we spend so much time on our journey talking about the fact that we can't wait till we get to the point where we start making consistent money from trading. We can get our time freedom back, right? We can live this lifestyle that we've been talking about and dreaming of. And it's interesting that there's this switch that has to go off in our mind where we fully allow ourselves to get to that point where we can enjoy it versus kind of being stuck in this mode of a normal work grind, if that makes sense. So instead, what we have to start doing is looking at it as in, once we reach our threshold of, let's say, what we call our basic salary. So let's say your basic salary from your trading profits is $3,000 per month. Once you surpass that, extra would be seen more so as a bonus that you would receive from a normal job. That should be treated in a way for investing and so on. Let's talk about a few different ways that you can actually invest. First one, of course, would be what most people would think about doing is just putting it in their bank account, right? Maybe putting it in the savings and earning a very small APY on that. I would say that is the option that you do not want to do because you know you lost. All right. The reason you know you lost is because if the bank is giving you 0.005% APY or something like that, and you know that every year the dollar is being devalued by several percent, why would you put your money there? You already know you lost. You might as well go gamble it away and be happy with a little sliver of joy you had from it. The minimum I'd ever look for to put my money in a bank account would be the 5% APY, and this is a high yield savings account. Now, once again, this is more so bare minimum, as in that's probably barely going to beat inflation, but possibly not. You could still possibly be losing money, but it will basically be bleeding out slower. All right, so I would use these high yield savings accounts more so as a place to sit the money until you truly know what you want to do with it. But it wouldn't be seen for me as an actual investment vehicle. After that, we can start getting into, crypto, stocks, real estate, all that kind of stuff. So let's go ahead and dive into real estate. I do have some personal experiences with owning real estate, purchasing a single family home, all that kind of stuff, and also looking into duplexes, etc. And this is a great investment, right? For the long term. Let me make that clear. If you're looking for a quick return on your money or something that is easy to get out of, then real estate is probably not the best bet to go. The reason I say this is because let's say you made $100,000 in your trading and you're like, hey, I want to put a down payment on a home. I want to wait to start building up the equity. Let's let it appreciate. We'll have some extra money and then we could refinance to get some out, or we could sell it at a higher price, etc. There's a lot of factors that depend on that price actually increasing, right? The market, it depends on how quick you're paying down the home. It depends on your interest rate you got the home for. Another thing you have to think about is all of the other financial payments that go into owning a property, right? So for a single family home, you have the lights, the gas, the property tax, you have the sewage, the trash, you have overall maintenance for the property. You have to get the ducts clean. You have to service the water heater. There's all these micro fees that build up, right? And although on the front end, it looks like an amazing opportunity, you're like, oh, they said the mortgage payment's only $2,000 a month. I'll be good. What you have to keep in mind is the micro payments that I just listed, because you may think that it's a smart investment for you, but then you realize like, oh, with property tax and everything else, I'm forking out another $1,000 a month that I wasn't really prepared for. Now, let's talk about real estate from the perspective of building equity. Now, when you put your down payment, what ends up happening is if you do like a FHA, you get it for around 3.5. If you do conventional, usually it's around 20% that you have to put down. And that's your starting equity. Now, once you purchase the home, it's going to fluctuate naturally, depending on the market, depending on the area. And it's going to take time for you to actually build equity. There's been time periods, of course, where it's jumped very quickly, 10 to 20%. There's also been times where it stayed very stagnant for a couple years, right? So if you're banking on buying a property and you're hoping in the next 6 months to a year that it goes up in value, 20, 30, 40, 50, 60,000. It's probably not going to happen unless we have another very rare event similar to what we had a few years ago and, see a surge like that in the market. So it's all going to have to do with inflation still. Inflation is good when it comes to assets because it means that people are putting their money in places that it can sit for a while to try to beat inflation, like houses, like gold, like all these different things, which is going to help out on the back end. All right. So just keep that in mind when you are thinking about real estate. Another factor that you want to think about is that when you're paying this house down, the only part that's actually paying the house down is going to be the principal of the payment. So let's say, once again, using the example of the $2,000 monthly mortgage fee, out of that, depending on your interest rate, you're going to have a certain amount that goes directly to interest. Usually it's somewhere around 50-50, maybe 60% goes to principal, 40% to interest, something like that. But nonetheless, out of that $2,000, you're most likely going to see around $1,100, maybe $1,200 actually going to the principal. Other $800 is basically being eaten up and thrown away by interest. So you have to factor in all of these different pieces to the puzzle to see if it's actually a smart investment for you. Now, what would sway me in this particular situation to actually want this house? Okay, there's different advantages to owning real estate. There's, of course, you owning a personal home, which is one. There's you leveraging a property as an investment, short-term and long-term. And then there's also building the portfolio out, such as trying to get a duplex, an apartment, and that kind of thing. So when it comes to owning a home, one of the biggest advantages is, of course, the write-offs. So because you own that property and you live in that property, you can write off the property tax and the interest that you actually paid on the home loan. So this is another kind of like, it's not a hack, but a lot of people don't get that when you buy assets, you do not want to pay full cash all the time, right? Because if you pay for the house outright, you're not actually getting the benefits of the write-off because you paid cash, so you didn't borrow any money for it. Even if you have the money, sometimes it's smarter to actually borrow. In this situation, you would get the write-off of the property tax, the interest, right? So that lowers your income for the year from your trading. And then you can also write off certain things such as your home office and other deductions that qualify for your business, which is trading. So in that situation, if you need a place to live anyway, if you're tired of paying for an apartment or, just paying rent in general, which is all going to the landlord, it can be smart to actually purchase a property. Now, you do want to think about this as in, are you a person that can stay in the same place for quite some time? Because you probably want to stay there 2, 3, 4 years to actually get the benefit of possible appreciation before you leave. All right. So that would be one thing I consider in that situation. So let's take this up to a different notch. So let's talk about investment wise. So let's say we bought this property to kind of hold as a rental. You can do a short-term rental or a long-term rental. Long-term rental is the most popular. It's going to be where you find a tenant that could stay in it for at least a year. Ideally, once you find that perfect tenant, you just want to leave them in that property as long as possible, right? So in this situation, you're not going to see the most money or profit per month. What you're actually looking for is the long-term appreciation and equity that's going to be building up. Because let's say we bought a property for $200,000. Let's say the mortgage was the $2,000 and we have another person paying that $2,000 and maybe, $2,100 so that we get another $100 over. They're paying the whole mortgage for us, which means that they're paying off the house for you. You still own the house, although you're not in it. So you're not seeing the perk of it immediately, as in every month you're making hundreds or thousands of dollars in profit that you can kind of live a new lifestyle off of. But on the back end, if you think about this over the next 5 or 10 years, you're like, hey, this person that I've been living in this home paid off $100,000 of my mortgage, or my appreciation from them living in it also went up $30,000 over this certain amount of time. So when you look at it like that, it is a great investment for the long term. So what you also have to factor in that situation is the possibility of something happening, right? So there can always be a storm. There can always be an AC unit that goes out or anything like that. So you do also have to think about the risk of it all, not just the reward. The risk could be that since you're barely making $100 over what the mortgage costs, if something big did happen that cost you a couple $1,000s, you're pretty much coming out of pocket for it, right? So one mishap, let's say an AC unit that could be a couple $1,000s, let's just say $4,000, how much would that set you back in terms of how much was paid from the tenant, right? So if the tenant's paying $2,000 a month, that's technically like 2 months you lost on top of, everything else. So it's good to factor in the risk to reward to it all. If you do have a savings already after you're able to actually purchase a property that you can use as an investment, that is a safer bet. So what I mean by that is after you get the property, do the down payment, figure out how much the property tax and all that's going to be, you say, hey, well, I still have a savings of $20,000 or $30,000. If something happens, it's not a big deal. I'm okay with the risk. Then that's perfect. But you never want to overextend yourself or over leverage yourself, because once again, with real estate, it can be very tricky trying to get rid of a property quickly. Because let's say the property goes up in value, now it's worth $300,000, but you're trying to get top dollar and you try to sell this property. Well, in order to sell this property for top dollar, you may need more time because you need to find the right buyer that is willing to pay that price, right? It's kind of like the markets with the imbalances, right? The market's searching for supply and demand always, and this happens in every single market. So if it's something that you need to get rid of quickly now, you're probably going to have to accept a lesser price, right? So you may not get the 300, you may get 270 or something like that. So just keep that in mind as well. If you're looking for something long term over the next 5 years, 10 years, that's a great investment. If you're not, you're looking to be able to touch your money a little bit more often, that's probably not the best route to go. Now let's jump into investing in stocks. So let's say we make some money in the markets, a prop firm pays us out a couple thousand. We're like, cool, this is extra money. What should we do with it? Let's put it in stocks. Now, stocks have been proven to be a great investment, right? It's one of the, I won't say the safest investment, but when we think about America, it's the most popular one, right? 401ks and all that. It's literally just investing into different stocks, ETFs, securities, all that kind of stuff. This is always going to be a viable option. If you're doing something like just investing into the S&P 500 or, the US 30 or something like that, and just holding it over time, it's been proven to produce results around, I believe it's like 10 to 11% per year. Some years perform even better, very phenomenal. Others are a little bit worse. But the thing is, once again, the time frame that you're trying to see this growth on. Right now, the market's at an all-time high, right? So if you put your money in here now, you can't expect that it's going to give you the same phenomenal returns that it did the last few years. And the reason I say that is because the markets, as we already know, ebb and flow, right? They go up, they go down, they consolidate, all that kind of stuff. If the markets are already sitting at an extended higher high point, eventually they're going to have to retrace, right? So it's not to say that you can't invest your money right now into the market, but you have to understand that it's going to end up retracing eventually. And there's a possibility your money's stuck up here at the top when it starts. So if I put 1,000 here, you may have to see it drop to 800, 700, 600, and you have to be able to weather that pull on your mental that makes you want to say, let me just take my money out and put it somewhere else. You need to allow the markets to do what they're built to do. And it's a vehicle to build wealth. So it takes time to build the wealth, and you have to be able to kind of like detach from the little fluctuations that are happening, right? So if you are looking to invest in stocks, what I would say to do is do your own research, of course. I will be giving some different ideas on this channel, but of course, I am not a financial advisor. All I can do is share my own opinions. Anything to do with what you're seeing all around you in the world is going to be a great investment. Right now, artificial intelligence has been blowing up. I mean, we have ChatGPT, we have Grok, we have Claude AI, we have OpenAI. We have all these different companies popping up. NVIDIA making the chips for these supercomputers, talking about, how it's going to rule the next 100 years on Earth. It's going to change everything. It's going to change how business is done and how cars run and how we compute all these different things. So look at what is being called the future. What is that next thing that's going to be taking over? That is always going to be a great investment. And once again, you may not see the results immediately, but over time, you will actually see that you were one of the early people in it. And that's the goal sometimes, is you don't always want to follow the crowd. Because we can say, yeah, throw your money in Apple, throw your money in this, throw your money in that. that's cool for making some nice gains because you see the consistency previously. But I think it's always best when you're investing into something like stocks to break your portfolio into different risk levels. And let's say you have $1,000 to invest, maybe take 10% of that to invest in maybe riskier stocks or investments that may not show much character just yet, but you do some research and you're like, well, it seems as though since artificial intelligence is taking off and this company's doing this, this, and that, their product hasn't released yet, but they said in 6 months it's going to launch, and it may be good to put some money into that to see what it becomes. At one point, Apple was a small company. At one point, Berkshire Hathaway was a small company. Nvidia was a small company. And the most gain came from, the people that were early investors. So I would always say, find a percentage to split your portfolio into that you're comfortable with, risk-wise, from safe, medium, and higher risk. Now, when we start talking about investing in stocks, crypto, all this kind of stuff, you do have to keep in mind the difference in long-term and short-term gains. So tax-wise, short-term gains get taxed higher. Long-term gains get taxed lower. So if you hold something for over a year, it qualifies for long-term gains versus under a year is short-term gains. So you do just want to keep that in mind as well. And there is also something else called, I believe it's called wash sale or something very similar. I'll double check the term and make sure I'm telling you guys the right thing. But basically, let's say that tax season is coming up, right? Or the end of the year. So it's getting close to December and you've been holding these stocks and you're in a drawdown right now. You put in $1,000, now it's floating at a worth of $500. There's also something called a wash sale where you can actually sell that stock for the lower price, buy it right back for the same price, and technically, since you sold it for a lower price than you actually bought it, you can use that as a loss on paper, on taxes, etc. So this is one way that you're able to create losses that can be taken against the profits that you're making in your investments. The cool thing about this too is, like, let's say that there's a limit to it, of course, but let's say, I believe the limit's like $3,000 a year of losses you can take. 2024, you had $6,000 in losses. You only can claim $3,000. They can actually roll forward to the next year. So now you can also write off the other $3,000 in losses for that next year against, your profits or whatever you made. So it's actually pretty cool. It's a way that you can mitigate, once again, some of the gain that you actually saw on your portfolio. And with stocks, is similar to owning real estate, but it's a little bit easier to get rid of, right? So you still have to wait. You still have to allow price to do its thing. But if you needed to access it, if you needed to sell it, it's as easy as going on your phone app, moving the money over, withdraw, and then it's in your bank account within a few days. So this is a little bit more lenient as far as being able to access your cash. Now, the last option that I'm going to talk about today is actually crypto. There's actually a lot of different ways developing that you can invest in crypto. You have the normal holding, kind of like a stock. You have the short-term trading, kind of like trading Forex or futures. You have staking, which is basically kind of like putting your money in the savings account and earning an APY on it. And then you also have farming, which would be more so like mining for tokens and all that kind of stuff, right? So the first option is very simple. It's something that I like doing on a regular basis, just kind of dollar cost averaging into different coins. That way, I'm not really worried about, this one's at $100, this one's at $1,000. But if I believe in the project, then I'm just going to put a small amount consistently into it, which could be daily, just do $1 a day. Maybe weekly if you have more money, $50, $100, whatever's comfortable for you. But by doing it every day, what ends up happening is it takes off a lot of stress. Because let's say that you had an extra $10,000 to invest and you invested it all at one time. Boom, I just put it into the market on this one token, right? You're going to be watching that $10,000 like a hawk. Every few minutes, maybe daily, you're just kind of like, all right, let's see what it's doing. Let's see what it's doing. Hoping that it's going to gain value. Versus, let's say you broke that $10,000 down to $100 amounts and you did it daily for a while. Every day you have less stress because it's like, okay, if the market went down, I only am in right now $100, $300, $400. And as it's dropping, if you're actually getting into the market, you're getting in at better prices than you would have at the top. So your dollar cost averaging into the market getting better positions, and then when the market does recover and goes back in the direction you're anticipating, you're actually benefiting more than you would have before. So it's actually a really good thing to do instead of just throwing all your money in at once. Dollar cost average in. Okay. Now let's talk about staking. There are a lot of platforms now that actually allow you to stake. One of those being Coinbase. They have Uphold. There's tons and tons online. You could literally just Google it. But there's certain tokens such as USDC, which is a stable coin, and others that are actual cryptos that will give you an APY for just simply holding the token and choosing to stake it. Okay. Now, when you're choosing to stake it, you basically cannot trade or sell that token. It's kind of being held in a lockbox, similar to your money in the bank, right? If you want to earn that APY, the money has to be sitting there. It's the same way. So like, let's say that I planned on holding Bitcoin no matter what for the next 10 years. Then it would be a good option to potentially stake it because I'm still earning an APY so that no matter what the price ends up doing on Bitcoin, if I'm planning on holding it anyway, I may as well make more money off of it, right? So similar to what we do with the bank, but we also have a greater upside potential because we have this confirmed APY. But then also, if we believe in the project, such as Bitcoin, Ripple, or these other ones, and the price ends up going up in the future, well, then that means we made money twice. We made money in different ways. So this is a great way to actually leverage an investment, right? So we always want to think about how many times can we make a dollar flip. And I don't mean that in a get rich quick way, but if I made $1 from my trading, how can I make this dollar into 2? And then make this dollar into 3 or 4, etc. That's how we want to think. So if we're able to take this dollar we made in trading over here, and then we're able to invest it into something else, and that dollar turns to $2, and then we take that and put it into something else, and it can turn into 4. Well, now we're getting from having to use the earned income and turning it into using the passive income. Right? Because that's the goal, is once we get to the point where the passive income exceeds the earned income, but now you're not in a state of survival or chasing or overworking. Now you have more time to really think about what matters for you in your life and how you want to actually structure it. And the last one, as we talked about, is kind of more like the yield farming or mining. So I personally do not have too much experience with this, I'll be honest. But if you are one of those people who are like a computer nerd and you understand the world of mining, it could possibly be a good investment. Now, I remember it was a couple months ago, it cost more to mine the Bitcoin than the Bitcoin was actually worth. So as the price of Bitcoin actually fluctuates, it could be a good investment or a bad investment. It's all going to be a risk at the end of the day. But once again, you have to decide your risk level, how much you have, and make smart choices with it. This is all just to give ideas, right? But nonetheless, hopefully this conversation sparks some insight within you, some ideas of how you can invest some of your trading profits. If you have any questions about anything I went over, or you want me to talk about some other ways to invest, please leave a comment down below and I'll be sure to add it in a new video. Take care. I'll see you in the next one.